Assalamu alaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm instructor Sheikh Mahadi. Today's subject is Finance and Banking, Chapter 4, Financial Statement Analysis. So we have dig so much deeper into the financial statement analysis this chapter. This chapter packs out a whole lot of maths, various types of maths of break-even, sometimes of profit ratios, margin ratios, debt equity ratios, trade credit, break-even analysis, break-even points, situation given maths, and sometimes they even show out charts. So let's take a look at trade credit. What's a trade credit? Trade credit refers to credit granted to the manufacturers and traders by the suppliers of raw materials, finished goods, components, or etc. So, trade credit refers to the granted to manufacturers by traders. Who are the traders? Traders of the suppliers of raw materials or finished goods to the manufacturer. Suppose I'm a wholesaler business, and I am the supplier to the manufacturer, the people of the company who are willing to buy my raw materials, products, or goods or components, whatever may be. I am a wholesaler and I'm selling it to them, the company's manufacturers. That's how the trade credit works. Trade credit works, we'll just explain it in the further, but let's take a basis on the trade credit concept. Usually business enterprises buy supplies on a 30 to 90 days credit. That means 1 to 3 months. Enterprises supplies on a 90 days or 30 days credit. That means 1 to 3 months period. This means that the goods are delivered but payments are not made until the expiry of period of credit. Like it's like buying something on credit. You just took something and you promise them to pay back the money after a certain amount of time. It's like in our local shops, in our grocer, people take their monthly shopping or monthly groceries, whatever they need, or just took small amounts of food, snacks, or vegetables, whatever they sell in the grocery shop. They take it for the whole month and give the payment at the end of every month. That's how the trade credit works, but in a whole different on a whole different level of scale. It goes from manufacturers to manufacturers to the suppliers in a different huge scale, not like the grocer and the consumer relationship. So this type of credit does not make fund available in cash, but it facilitates purchase without making immediate payment. So as I said, it's a credited sales or credited purchase. It's a credited purchase. So it's a quite popular source of finance, even in the industrial sector, even in the domestical sector. People take products and pay the money later. So trading, there are some features of trade credit. Trading on credit. Trade credit is created by credit purchasing. If a trade occurs in cash, there is no opportunity for trade credit. Why is it named trade credit? Because sellable goods are taken in and then the money is paid later. That's why even if it's done in cash, it cannot be named as trade credit. Simple as that. So reselling. In order to be trade credit, the buyers must buy the goods and services with the intention to resell them. Suppose I just bought a whole bunch of materials or consuming goods or raw materials or finished products. I just cannot keep them sitting at my godown or my warehouse or my house or anywhere. I have to take an intention of selling them because I bought it. I have to pay the money by selling those. I just cannot give out the money within my capital out from my own pocket. That's why reselling has to be one of the main motives of when you're doing trade credit, like taking goods and giving the payments later on. So less formalities. In trade credit, the seller and the buyer do not need to maintain many formalities like other sources of short-term finance. Short-term finance are kinds of different sources, like the bank loan is also a kind of it sometimes is a short-term finance and sometimes it's a very long-term finance. Some short-term finances ranges within 1 to 5 years. Those are called the short-term finance, and long-term finance are what exceeds the 5 years time limit. That's called a long-term finance. So in trade credit, people usually take a huge or a bulk amount of goods or raw materials or even sometimes finished goods, and they have to pay it at the end of each financial given year. So that's how the less formalities is given between the purchaser and the seller. Maturity. Generally, the maturity period of trade credit is 1 to 3 months. Sometimes the seller may extend the credit period. As we said, 30 to 90 days is mostly the formal time to pay back the money that was borrowed or the goods that we took and the money we didn't give off. So the main or the most formal time is 1 to 3 months, 30 to 90 days. Security. In case of trade credit, the buyers of the goods and services do not require to maintain any kinds of security. But what kind of security can we expect from this kinds of thing? If we're dealing with like trade credit transaction with someone, that person has to be known and has to be trusted. Without being trusted someone or trusting someone, the seller or the buyer, none will be comfortable with any of them. So mutual trust and good relation. The base of trade credit is a mutual trust and good relation, as I just mentioned in the security case. Security, where does security do not belong? Where people trust and have a good relation with each other. That is the place where security does not exist. It ceased to exist. Availability. Trade credit is the most available short-term finance for all types of businesses. Less risky for buyers and the goods services. Trade credit is risky in source of financing other than other sources of finance, other sources of short-term finances. Cost of trade credit. The cost of trade credit depends on the cash discount and the rate that the supplier is giving to the purchaser or giving to me. The cost of trade credit is higher than other source of finance. It is usually higher because it's a very short amount. It's a very short process. Does not require any kinds of governmental issues, terms and conditions, or legalized papers or anything. Purpose. So what's the purpose of trade credit? It's to collect necessary amount of money to buy raw materials. Okay. So let's just take a look at the maths, or let's not at the most. We can say, is there any cost of trade credit, or how will we calculate this? Like bank credit and other sources of credit, the trade credit has also its cost. In case of trade credit, the seller for a specific period of time has to pay the specific amount of money that he was given. But when the supplier gives off the product, he gives it a few conditions, like if the money is returned within 15 days or 20 days, we will get a discount of 4, 5, 7 or 8 or 10% discount. And after that, he says the money has to be paid within a certain amount of time. It may be 1 month, 30 days, 60 days, 40 days, 25 days, 35 days. That's how it works. That means if the buyer says within a limited amount of time we can give out all the money, we'll get a discount. That means we do not need to pay all the money, all the amount, but within a fixed amount of time, we have to pay that amount of money. So let's take a look at our math. For example, Mr. Anwar wants to sell materials to Mr. Anil in terms of sales of 310, 3 is to 3 divided 10, net 30, which means in 10 days, if he returns all of his money in 10 days, he will get a 3% interest, in which discount, 3% interest, 310 net 30. That means within 10 days, if he gives all the money in 10 days, he will get a 3% discount. But net 30 means within 30 days, he must pay all of his payments. So we can just take a look at the formulas. What's the formula? 310 net 30. It's basically percentage of cash discount, which is in 10 days, 3% will be given on the entire cash. So that is the cash discount. So 100 minus cash discount, the same 365. It's a 1 year. And credit period minus cash discount. What is the credit period? Credit period is 30. That means within 30 days, all of the money has to be returned. And what is the cash discount period? Cash discount period is within 10 days, 3% discount. So 10 days is the cash discount, 30 minus 10. So cash discount was given 3, 100 minus cash discount is 100 minus 3, it will be 97, 365, 30 minus 10, 20. 3 divided 97, it will be 0.0309 into 365 divided by 20, which is 30 minus 10, credit period minus cash discount. We will get 18.25. Multiply that 0.0309 into 18.25, we will get 0.5639, which is eventually, if we convert it down to a percentage level, we will get 56.39%. So that's the ease of all trade credit. So as we knew, trade credit is a amount or a process where the supplier will give a certain amounts of speculation or the regulation, or it's a kind of mostly an offer. Let the credit term transaction be 310 net 30. That if you are willing to pay my money within the time limit I gave you, the offer time limit, within which if you pay it back, I'll give you a discount, but within a certain amount of time, you must have to give my money back. So that's trade credit in one simple way. If you have any kinds of question regarding this class, please let us know down in the comment box below, and be with Gurukul. Thank you.